Hello, I'm Mike Pugliese, Senior Economist with Wells Fargo, and joining me today is my colleague and fellow Senior Economist Sarah House to discuss the economic outlook. So Sarah, a lot's changed since we published our economic forecast about a month ago in mid-March. Can you walk us through some of the biggest and most important developments for the economy since then?
It sure has. So one of the biggest developments that we've seen over the past month or so was the announcement of significantly higher tariffs across really all of our trading partners. So we saw with the announcement from President Trump on April 2nd, we saw a universal 10% baseline tariff across all countries. We also saw higher tariffs on more than 60 countries for that were being called reciprocal tariffs. Now, those tariffs have had a 90-day pause since then, as we did see a lot of turbulence in financial markets, but at the same time we've also seen a further ratcheting up in tariffs against China. We've seen some exemptions trickle in, but bottom line here is we're looking at an environment with significantly higher tariffs across our trading partners. So we estimate that even setting aside China, we've seen the average effective tariff rate go from 1% or so over the past 20 years up to what's probably over 10%. Now, there's still a lot to be settled in terms of the exact tariffs. We think how long they stay on, if we get certain carve-outs, but we're looking at a lot of uncertainty for businesses in terms of what their cost structure is going to be in the coming months and even years, and also a lot of questions over the growth outlook in the coming months as well. So Mike, let me turn it over to you. What changes have we made to our forecast in light of these trade developments?
Right, so we've made some pretty big downward revisions to our forecast for economic growth. And the reason for that is you've got reduced consumer purchasing power from much higher tariffs on U.S. imports. You've seen some retaliation by foreign countries as they've raised tariffs on U.S. exports. And you've also seen the just much higher uncertainty impact that you mentioned a moment ago as businesses try to weigh what this policy outlook is going to look like, not just over the next few weeks or next few months, but over the next few years. So from a growth standpoint, we're talking about essentially zero economic growth for the year. Real GDP that by the end of this year is roughly unchanged from where it was at the end of 2024. Contrast that with 2.5%, 3% growth rates we've seen over the past couple years. It's a pretty big slowdown. Similar on the unemployment side, where we've got the unemployment rate rising about 50 or 60 basis points from its current level of about 4.2%. And while that's a big change from where we've been over the past couple years, I do want to just say that in the grand scheme of history, that's a relatively modest slowdown if you're comparing it to COVID in 2020 or the financial crisis in 2008 or even more average recessions like what we saw in 2001. So, while this is a big kind of negative revision to our economic forecast, it's certainly not on the scale of some of the recessions we've seen over the past few cycles. Now, maybe kicking it back to you, Sarah, what about the inflation side of things? What are we thinking about when it comes to the price growth outlook over the next few months and next couple years?
Yeah, so the good news is we saw the March inflation data generally come in softer than expected. So that tells us that businesses are at least not preemptively raising prices. And in other words, also you don't have we don't have inflation that's so far off the Fed's mark kind of heading into this higher tariff environment, but tariffs are still coming. So we don't think that businesses will probably raise prices all at once, just given that there is still so much uncertainty over what the eventual rate is, how long they stay. We also saw firms do a lot of stockpiling ahead. So we saw a massive surge in imports over the past few months for both industrial inputs, but also consumer finished goods. And with margins across a lot of goods-related industries still pretty healthy right now, it looks like there's some room for those businesses to absorb at least some of the initial cost of these tariffs as they wait to see maybe where some of these rates eventually settle. But at the end of the day, tariffs are designed to raise prices, so whether that's for revenues or to help support domestic production, so it allows domestic firms to raise prices more, and it still increases those costs of goods coming in from overseas. And so we do think inflation is headed higher. So we're estimating that you see the core PCE deflator, which is what the Fed benchmarks how it's doing on its 2% inflation goal. We think that's probably going to climb to somewhere around 3.25% by the end of this year. And we think it's going to stay above 2% over our forecast horizon through 2026, even as we see growth slow, because it is going to take time, we think, for some of these higher input costs to filter through consumer goods. And also, just as the longer these tariffs stay on, it's going to get harder for businesses to actually absorb them through the margins if these higher costs stay in place. So Mike, what do you think that means for the Fed, given that they're going to be looking at higher inflation, but also weaker growth this year?
Yeah, so for the Federal Reserve, this puts them in a bit of a bind, right? The standard playbook in the face of an economic slowdown would be to start easing monetary policy, right? If you see economists ratcheting down their forecast for economic growth, ratcheting up their forecast for unemployment, you see a lot of volatility in financial markets, you might expect monetary policymakers to come out and start beating the table for a series of rate cuts, much easier monetary policy. We haven't seen a whole lot of that so far because of the inflation side of things, where price growth has been above the Federal Reserve's targets for at least a few years now, and given the tariff outlook, that's not likely to change for probably at least the remainder of this year and according to our forecast, well into 2026 as well. So where does that leave the Fed? It leaves them a little bit boxed into a stagflationary corner. Now, it's our expectation that they will cut rates, that ultimately they'll put a little more weight on the downside risk to the economy and the labor market, and they'll put a little more faith into this inflation rise being transitory and inflation expectations remaining well anchored. And so our forecast is for 125 basis points of easing this year. So if realized, that would put the Fed funds rate in the low threes by the end of this year, and then held there throughout 2026. But again, that's not nearly as much easing as we might see in other periods where there's a sharp economic growth slowdown, in part because of the inflation story, and in part, again, because this is a lot more modest than maybe what we've seen in past periods where the economy was either in a recession or on the cusp of one. So easing from the Fed, but we're not talking about cuts to 0 or even 1 or 2% Fed funds at this point in time.
Well, thank you, Mike, for your insights. And from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.